Ma'am, no, I request you to please start the session. We are on live.
Kumar, Shri Santosh B. Nair, Shri Richard Wolff for accepting our invitation and sparing their valuable time to address the industry.
Ma'am, request you please restart the session.
Yeah, am I audible now? I am very sorry about this. Can I start the session now?
Please,
You're audible now.
Thank you for this glitch here. A very good morning to Shri Manoj Kumarji, Member, National Highways Authority of India, Government of India, Shri Santosh B. Nair ji, Chairman and Independent Director, Reliance Nippon Life Insurance Company Limited, Shri Richard Wolff ji, Executive Director, International Credit Insurance and Surety Association, Shri Vikas Khandelwal ji, CA, Ecorago Guarantees, Shri Venkateshwaran Narayanan. Partner Financial Risk Management KPMG India, Shri Basudev Mukherjee, Assistant Secretary General ASSOCHAM. the ASSOCHAM esteemed members and distinguished guests who have joined us to attend this timely and very meaningful discussion. On behalf of ASSOCHAM, I extend a very warm welcome to all of you at ASSOCHAM National E-Summit on Surety and Guarantee Bonds, playing an imperative role for country's growth, and my special thanks to Shri Manoj Kumar, Shri Santosh B. Nair, and Shri Richard Wolff for accepting our invitation and sparing their valuable time to address the industry. As you all know, that surety bonds have supported the development of the modern construction industry by underpinning and encouraging sound, solid business practices and business decisions. Surety bonds help to ensure success and growth of bonded firms. From small local projects to huge public and private development, surety bonds guarantee of the project up to the surety bond limit. In many cases where surety bonds are part of publicly funded infrastructure and development projects, they protect all of us from the loss, whether public or private sector, large or small. Surety bonding has played an important role in creating our history and will play an important role in building our future. Given the country where we are, India, and the infrastructure need, these bonds will play a very big role in times to come on how we can look at the under construction project. General insurance companies are wading into the uncharted territory with surety bonds as they grapple with regulatory process and product related challenges on these unique products announced in the budget. Surety bonds issued by insurance company are designed to provide guarantee to government agencies or companies for the delivery of projects. Small businesses buying these unsecured bonds will have to pay small premium to an insurance company in exchange for an underwriting guarantee in case of default in a project. Although IRDA has given regulatory approval and mentioned that insurance companies can offer 6 types of sureties, namely advance payment bond, bid bond, contract bond, customs and court bond, performance bond, and retention money, insurance companies are still in process of filing for approval of these products with IRDA and are in dialogue with reinsurance companies to design, price, and underwrite this new project. However, the insurance companies are still unsure about how reinsurance companies will underwrite this risk, which is crucial for them to launch this product. The question is how to protect policyholders and shareholders, which is very important. General insurance, by definition, is an indemnity product, which means it guarantees to restore a person or an object as he was and when he or she took the policy. The surety bond is being proposed is without collateral and is fraught with risk. It is not purely an insurance product and it is not like a bank guarantee either. So it's an unknown territory for most of us. While the move may be very beneficial for small entrepreneurs who do not have luxury of offering bank guarantee, and the simplicity and the acceptance of product would determine how many small entrepreneurs would like to use it. Unlike a bank guarantee, there is no collateral in this product, which is the issue. Banks have been offering guarantees for many years now, whereas for an insurance company, this is the first time. So what recourse is available for insurance company, which could also have an impact of capital and reinsurance arrangement, which requires clarity. Insurance company also have a high solvency margin of 1.25 times of control level of solvency specified by IRDA. So if solvency margin of the insurance falls below that limit, they obviously will not be able to underwrite the further surety business, and solvency margin has to be restored above that. But insurance company can work with banks, other financial institutions such as NBFC to share risk information, technical expertise to monitor projects, cash flow amongst the other aspect. However, the guidelines noted that they surely insurance contracts are to be offered to infrastructure projects. Hence, details around their applicability on government procurement is yet to be ascertained. Even the MSME experts have hailed the government decision to allow surety bond substitute for bank guarantee, because it's a major move where they don't have to go through every time approval or a yearly approval to do this. The guarantee invoked by any government department to recover or realize amount in case of vendor defaults unable to fulfill the contract or complete the project. In order to secure bank guarantee, the vendor is required to commit a hefty security deposit, put a margin money, have a working capital impact, whereas this can work very very well for most project as well as the MSME sector. The bank guarantees are expensive and it is recovering. However, surety bonds will require an expertise in insurance company to ensure that such risks could be underwritten. Hence, it would mean the cost you will pay for surety bonds should be lesser than the guarantee commission by the bank. But more than that, I think ability to provide solution for life of construction, especially for infrastructure building, can go a long way in terms of how these bonds can help Indian infrastructure and Indian bond markets in times to come. With these words, I would like to conclude my address and would like now request Mr. Venkateshwaran Narayan to kindly deliver his presentation. And then we will have a discussion about the question answers post all the address. Thank you so much.
Thank you very much, Nipa. I think great opening comments in the context of the guidelines that have been put up by IRDAI. I hope I'm audible well to everyone on the call right now. Okay, thank you. Thanks for that confirmation. So Mayank, if you could please put up the presentation we had shared with you. Great, thanks. Could you go to the previous slide, please, and put this on presentation mode, full screen? If you could go to view and pick up full screen from there, please. Yeah, lovely. Thank you. Right. So what I'll try and cover in the course of the next 5 minutes or thereabouts is give context about how this has come into being and the guidelines from IRDA, and then give a certain global perspective on how the numbers are in the context of business internationally in the surety market. What I would like to focus on particularly, just so that I don't repeat the comments that have come through already in the opening address from Nipar, is focus around the product differences between a surety bond versus the conventional bank guarantee, and touch upon what we see are potential matters for consideration in terms of how this product progresses through its journey here on, and what are the kind of aspects that will be very, very crucial from a successful implementation standpoint. So as we all understand, IRDA has been in the thick of action in terms of trying to bring out these guidelines on the surety bond products. And earlier in January, they came out with the guidelines, which are now going to be effective from 1st of April 2022. As we all understand, COVID-19 only aggravated a lot of the problem statements which historically also existed with reference to getting access to cheaper sources of finance. And COVID-19 started off with a lot of these small contractors and small suppliers and vendors who support the infra and the construction sector, witnessing a lot of funding pain. And obviously all of this translated into higher project delivery costs and in some cases inability to deliver work as well. Now, in the light of the developments, certainly the surety bond product is a welcome step in the context of how infra funding in the Indian context is likely to evolve. So Mayank, if you could go to the next slide, please. Mayank, could you move to slide 3? We need to, okay, you can stay put on slide 4, not a problem. Slide 3, just to give a perspective, was all about certain premium numbers in the context of how the surety business has evolved. I believe ASSOCHAM will be circulating the presentation separately, so all of you can read through at that time. But the global landscape, just for everybody's information, is that the surety business is pretty active and quite sizable in the North American region and the Latin American region world over. And that's what we've seen as one good reference point for this business is also to pick up in the Indian context. Like I mentioned, what are the conventional sort of differences between the surety bond product and the bank guarantee? As Nipa rightly pointed out, security or collateral is something that is not seen in the context of a surety bond. So this should definitely help the smaller contractors and vendors who participate in the infra and the construction space. From a skill set standpoint and an operational guideline standpoint, while general insurance companies do have underwriters, there needs to be some relook and some thought process around how they get on board project specialists, people who understand project finance and who are able to evaluate the underlying risks in the context of any suppliers or contractors' ability to pull through an infra project or deliver an infra project. I say this because all of these will have a very direct bearing on how the underlying or inherent risks are identified by the actuaries and how they eventually choose to price the surety bond product that the company will then be looking to issue. And one key consideration in this aspect, if you look at surety bond vis-a-vis bank guarantee, is that internationally surety bonds also come up with some kind of an underlying maintenance period post the issuance, and not just looking at it as an annual renewal cycle that typical GI products are usually associated with. So therefore, from a risk assessment standpoint and a pricing standpoint, the time span or the duration over which the contract has to be delivered and what possible delays, escalations are likely to come through, which is par for course in the context of a lot of these contracts, will all have a bearing on how the actuaries risk assess and price the underlying product. And last but not the least, the overall challenges when it comes to invocation, because if there is ever an instance of a default or a certain condition not being fulfilled and the surety is invoked by the beneficiary eventually, how does the surety or the insurance company step in to deal with the situation? Will it be paying up? Will it be looking for an alternative contractor to take over from the existing service provider? All of these factors will have a bearing in terms of addressing the issue at that point of time. Conventionally, it's paying out the beneficiary of that surety bond, but will these alternatives be allowed in the context of dealing with the situation are matters which one needs to try and understand and explore further. And it will happen as the product evolves over the course of time. So at this point, Mayank, could you go to slide 5, please? So what it means for the general insurance players, I already spoke about the first point, which is on the detailed risk assessment. And like I said, this is not just going to be a point in time on day one. This is something that is going to require periodic review and continuous monitoring, as is called out in point 4 on the slide. And therein lies the inherent challenge in terms of how do we eventually achieve symmetry in data sharing and data compilation, because we understand from the IRDA directives and the guidelines that there are certain caps that have been established in the context of the GWPs that can accrue from the surety bond product. Compliances, as Nipa rightly pointed out, around the overall solvency margin that the insurance companies need to maintain, because this is a high risk engagement, and therefore only the players who have the ability to stomach that level of risk appetite will eventually succeed in this play. So how do they share the information, and how does IRDA sort of manage the overall data flow through a central repository is going to play a very, very important role in a seamless implementation of this surety bond product over a period of time. I spoke about upskilling, and that's where dependencies will come through. And as IRDA has also rightly pointed out, data sharing with banks and other institutions who are involved in funding infra projects is going to be very, very critical. And how does the reserving build up in the GI company over the span of the products that have been issued on the surety bond side will help them with buffers should there ever be an invocation that comes through. And obviously all of these with experience will have a bearing on actuarial assumption and will refine the overall pricing mechanism over a period of time. And as is the case, as one common concern point in our context is how clearly are the contracts worded and articulated so that there are no interpretation issues on who steps in at which point of time will play a critical role, and how the reinsurance market emerges, either direct reinsurance or through an implicit government guarantee, as is the case with certain international markets, will have an important role to play in the expansion of the surety bond product and companies being able to better risk manage. Mayank, if you could go to slide 6, please. Great. So one key takeaway which we thought, because it seems from a plain reading of the directives that possibly the GI companies who issue the surety bond products may not get the status of financial creditors under law or through the product directive, and possibly to secure their interest, because eventually they also need to recover monies in the context of an invocation scenario. If they get cover within the IBC framework in terms of being treated as a financial creditor, possibly it will go a long way in strengthening this product and its marketability. And like I mentioned, in the US, there is this practice of having a counter guarantee coming through from the government to the surety bond issuers to that extent. And that does help create better liquidity for this product and acceptability for this product in the market space from a risk management standpoint. And database building for achieving symmetry in information sharing is going to be very, very critical, because there needs to be transparency and clarity around the service providers, the contractors, and their track record, so that over time, as the book is built for the surety bonds that are issued, the companies are more transparent and are able to better risk price this, and hopefully be more competitive, or as competitive as the bank guarantee market is right now. At this point, Mayank, if you could go to slide 7, please. And definitely, this is a win-win for infra players and the surety business providers. As we already spoke, this is going to be clean or non-collateralized in that sense, and will free up a lot of working capital for the contractors and service providers who are supporting the infra development and the construction sort of development. And in that context, how the product evolves, price discovery and ongoing risk monitoring are going to be very, very critical, both for the infra player and the surety bond providers. So overall, this looks like a win-win proposition for the broader market from a government standpoint on infra spending or construction spending. Getting in the GI players from a surety bond product is only going to make things that much more transparent. And obviously, it's a welcome change for the small contractors who otherwise grapple with working capital or delivery capabilities, in contributing to the infra development in the country. So with this, I'll conclude my short presentation and hand it back to the next speaker and to Mayank as well. Thank you.
I will request Vikash. Thank you so much for such a good presentation, and I think it gives a great insight. I will request Mr. Vikash Khandelwalji to take up the next session, please.
Thank you, Nipa. A very good morning to everyone. I'll start with a little bit of a trivia. Contrary to popular perception, I mean, this is actually not the first seminar on surety and guarantees which is being held by the ASSOCHAM. So around 4.5 years back, ASSOCHAM had actually organized a seminar, a summit on sureties and guarantees. That was way back in 2017, and I also had the opportunity of participating then as well. Well, things are a little different now. We didn't have the regulations then, and the IRDA has announced the surety guidelines earlier this year. And I must say, so right from constitution of the working group to announcing the surety insurance guidelines, IRDA speed has been quite commendable. I mean, definitely took us by surprise, and this was a very pleasant surprise. I believe the guidelines are a big step forward. The surety insurance opportunity in India, it's huge. There were about 11.4 lakh crores worth of bank guarantees which are issued to the infrastructure sector alone. Over and above that, we've also seen the government's continued thrust on infrastructure. Last year, the government had announced 100 lakh crores worth of investments in the Gati Shakti Master Plan, which is the multimodal connectivity using 5 rivers and about 25,000 kilometers of highways. To add to this, we've got the state governments investing cumulatively investing about 5.5 lakh crores on development or infrastructure projects at the state level. We also are now witnessing a very strong and an enabling environment that's going to be made available to the surety industry. It's a fledgling industry, but I think we've got very strong tailwinds, and these tailwinds are in the form of governmental support. One example in this case is the day the budget was announced, which allowed the acceptance of surety bonds as an accepted security by the government agencies. The GFR norms were amended the very next day. So in fact, we had the budget on the 1st of February, and the GFR norms came on the 2nd of February. As far as data is concerned, I mean, for the surety underwriters, there's a lot of good quality data which is available at the 4 credit bureaus that we have in India. And this includes a lot of financial information that can be shared with the surety underwriter that can be made available to the surety underwriter from the credit bureaus. The surety guidelines, they've also allowed the surety companies to access and also share data with the banks and the contract awarding bodies. So which could actually make available to them critical financial and performance related information to the surety underwriters. And this could include guarantees invoked in the past, cash flows, project execution track record. So in a nutshell, the data that's likely to be required by the surety underwriter in trying to assess whether he'd like to extend bonding limits to a contractor or not is actually available to the underwriter, and that too in a very constructed manner. It's available in there. Now, surety bonds have been a very long-standing demand of the contracting community. And the narrative has been that banks require contractors to indemnify the guaranteeing limits, and this is by way of collateral, which would come, so real estate would come in as a collateral, and also require margin money. Now, a small to a mid-sized contractor in India is usually required to post about 100% of collaterals for the banking guarantee limits, and margin money that could range anywhere between 10 to 35%. Yeah. Now, while this sucked out liquidity, this is only part of the narrative. So bank guarantees actually bred inefficiency. Sureties, on the other hand, will not require the contractors to put up collaterals and margin money. This will infuse a significant amount of liquidity, which the contractor can use in the execution of the project. Now, this is only one part of the narrative. Sureties also help bring capabilities to the project by ensuring that only competent contractors are permitted to participate in public infrastructure projects. They also bring in certainty in the form of performance and payment assurances. So if you really look at the full picture, I mean, it's actually surety insurance is a no-brainer. The challenge, however, is going to be that surety bonds are being a new concept in the country. There's a dearth of surety-related expertise, and this could eventually delay the rollout or making surety options being available to the contracting community. There is a considerable amount of demand already there from the contractors, but supply could be a constraint. Now, going forward, what is it that I'd like to see? One, of course, is recourse. The guidelines that have been announced by our regulator, I'm sure they are work in progress, but the guidelines are currently silent on the recourse available to a surety. Now, a surety, while is allowed or is granted the right of subrogation under the Indian Contract Act, it's still not clear as to how the other regulations like the IBC or the SURFACI would operate with respect to sureties. I think it's imperative that the sureties are considered at par with the banks, something similar to a member of the consortium, because at the end of the day, it's a financial exposure that a surety insurance company would be taking on the contractors. Now, surety underwriting also assumes a zero loss. So that's basic of surety underwriting. So clarity on the recourse is actually going to be very critical on the growth of surety as an instrument. Number two, specialist surety companies. Now, surety is a new concept in the country. I mean, even the word till some time back was very new to the country. So there is a lack of awareness, and then there's the dearth of expertise in the country. Now, the 10% cap that is imposed by the guidelines will not allow or may not allow many insurers to achieve the kind of scale and diversity of the risks, and might eventually deter them from underwriting these lines of business. As such, I would ideally like to see the introduction of monoline surety companies, which are the specialist surety companies. This will enable investments into the creation of capacities, expertise, and ensure adequate focus as well, because these companies would not be doing anything else but surety. The other challenge and something that I'd like to see in the very near future is awareness. And as I've mentioned before, it's actually a very new concept. So it's only normal for both the insurers as well as the project owners to approach it in a very tentative manner. Now, so it's critical in the interest of every stakeholder that they understand the importance of sureties and the efficiency that it brings in the execution of large infrastructure projects. And some of these infrastructure projects can be quite complex. So awareness is going to be key. The government and this is what I believe, that the government and the industry should actually partner with each other and ensure that the benefits are visible to everybody. And that's going to encourage people to start issuing sureties, accepting sureties as an instrument. The GFR norms, even though they were changed on the very next day post the budget, I would like to see, or rather I would suggest that the state governments also follow suit very quickly. So because some of the state governments can actually have very different norms from the GFR, right? And one case in point is everybody would remember that there were certain announcements by our finance minister, Mrs. Nirmala Sitharaman, during the first wave of the pandemic, where the bank guarantee limits, the bank guarantee requirements were reduced for the infrastructure projects, right? Incidentally, while some of the state governments had implemented it, a large number of the state governments did not implement the reduction of bid bonds, or rather removal of bid bonds from bank guarantee to just a declaration. Even the bank guarantee requirements for performance guarantees were not reduced from the 10% to the 3% that was announced by the finance minister. So it's going to be extremely critical and key to acceptance or key to growth of surety as an instrument, that the state governments start also accepting surety bonds as an accepted security. Having said that, I'm fairly confident that this is going to be one hell of a interesting space to watch out over the next few years. Because I'd like to see, it's going to be very interesting to see the insurance industry gearing themselves up to deliver surety solutions to the contracting community. Yeah, that's about it all from my end. Thank you. Happy to take any questions.
Thank you, Vikashji, for such a great address. And I think it surely allows all of us to have some questions on how these bonds are going to function and whether it'll be across the governments or no. I would now request Shri Richard Wolff-ji, Executive Director, International Credit Insurance and Surety Association, to give a special address to this audience. Thank you so much.
Madam Chair, dear speakers, esteemed attendees, thank you so much for giving me the opportunity to speak at this highly esteemed e-summit. And the subtitle, playing an imperative role for the country's growth, is so aptly chosen. My compliments. My name is Richard Wolff. I'm Executive Director of ASSOCHAM, the international organization in which the vast majority of private capacity for trade credit insurance and surety are united. Our members include the largest surety companies of this world on 6 continents, as well as the reinsurers. We represent our members and share information on our lines of business, as well as promoting best practice amongst our members. This ranges from discussions on highly technical matters to organizing physical and virtual gatherings on surety and trade credit insurance. In fact, we're in the middle of our virtual ASSOCHAM Surety Week. And if you register on our website, assisa.org, you will be able to see a panel discussion on surety in emerging markets in some 2.5 hours. And Mr. Agarwal will ably represent the Indian market, whilst we have participants from the Asian Development Bank, a company writing surety in sub-Saharan Africa, and the president of the largely Latin American Surety Association, PASA. It's professionally gratifying to be with you, but it also gives me great pleasure after having worked in the Indian insurance market over a decade ago. My heart still beats for India, its economy, its people, and of course, its cricket. Now turning to surety. We're extremely happy with IRDA's guidelines on surety insurance contracts of January 3rd of this year. And we were extremely happy to be given the opportunity to contribute some of our knowledge and experience to this. Please rest assured that ASSOCHAM will continue to be of help in making this line of business a success in India, and it will be. Now, to give you an international perspective, which was also given by Venkatesh, we estimate the worldwide surety market to be around $11.2 billion in premium, which, if my math is correct, equates to 84.4 thousand crores. It's a bit of a question mark because the question is, what do you count as surety? IRDA has excluded financial guarantee from its definition, and that is well chosen. Not all regulators do this. Some markets are advanced, such as the US, Japan, and Italy, to name a few. The list of markets where surety is offered is a long one. The People's Republic of China is quite a recent addition to the list. The reason for that is clear. Surety helps develop the economy and diversifies risk over both domestic and international risk carriers. This was well recognized in South Korea, where surety has been successfully used as an instrument in the government's economic toolbox. Perhaps just as interesting for you is an analysis of the Brazilian market. Surety has been in the market longer than anyone can remember in Brazil. The cable car to the top of the iconic Sugarloaf Mountain in Rio is even called the bond, as the performance bond that was issued for its construction is attached to it in a brass plate. That is about a century ago. Now, as is the case in India, Brazil had a large need to develop new infrastructure, defined as roads, electricity, telecom, railways, and water. In 2003, the Brazilian Development Bank dispersed $6 billion for infrastructure projects. This grew almost to fourfold 10 years later, backed by surety. The surety enabled the Development Bank to refinance itself at attractive rates of interest. Whether this is done by a development bank or by private lenders is not important. The same principles apply. As an added benefit, we saw a boost to the SME sector in construction and servicing, and this in turn stimulates the economy. The interest rate aspect will grow in importance. As we all know, interest rates are on the rise globally, and the developments of the last week in Eastern Europe do not help. By taking risk elements out of a project, for instance, the performance risk in the construction phase, but also for awarding concessions to have the public sector partner with the private sector, stimulates infrastructure development. Where government resources are finite, this is a well-tested mechanism for boosting infrastructure. Surety can contribute to making this possible. This is perhaps a second step. And talking of second steps, the guidelines of January 3rd is an excellent first step. It puts the surety industry on a track of development. Much is to be learned, and I'm sure the Indian companies, with the help of international surety companies and reinsurers, will learn quickly. Given the sheer size of desired and needed infrastructure investments in India, this speed is necessary. It is for this reason that I hope the next step is taken by the regulatory authorities expediently. This would necessarily entail expanded possibilities for surety to do more business and for larger projects, for instance, by raising the 500 crore limit and measuring this on the basis of net retained premium instead of gross written premiums. This plays very much to what Venkatesh told us earlier. The development of a reinsurance market is vital for this industry, and the reinsurance market is there. My members are looking at India, and over the past 4 to 6 weeks, I have talked to numerous of my members, both primary and reinsurance, about the Indian market and how it is possible for them to contribute to its development. It can also include the possibility for insurance companies with surety as their only line of business, so-called monoliners. This promotes specialization, focus, and therefore accumulation of knowledge. Again, thank you so much for giving me the opportunity to share this moment with you, and be assured the surety market is watching India and wants to contribute. Thank you very much.
Thank you so much, sir, for such an address. I would now request Shri Santosh B. Nair, Chairman and Independent Director, Reliance Nippon Life Insurance Company Limited.
Thank you. I thank ASSOCHAM for inviting me to this conference. It's a very informative conference. Although, let me say that although I'm chairman of life insurance, my background is basically a banker. So I was heading the corporate banking of the largest bank in the country. And in order to avoid repetition, I would like to concentrate on the issues why this bond this is required in the current environment. And there's more from the banking perspective. Over a period, what has happened in India is that the contractual award and contractual design and also the keen competition to do EPC has resulted in a lot of wrong bidding and wrong awarding and not insufficiently mature process. So for the banks, the EPC or a concession industry has become a sort of anathema. It is extremely difficult now for many companies, unless you're very big and you're well known, to get guarantee limits, either existing additional limits or new limits. And for the small kind of companies, it's very difficult. Like earlier speakers said, we need to provide 100% collateral, then 25 to 30% margin. It makes it extremely expensive. India is now planning about 7 trillion rupees of investment in the next 5 years. I don't know whether it will happen, but a substantial portion of it bound to happen, because it's also imperative for the government to drive up infrastructure to boost the economy. Now, this we cannot happen with existing bank limits and bank support. The reason is that Indian banks are not very capital fully strong. There is not enough adequate capital for the banks, and the exposure limits which the banks set for many clients includes the guarantee limits. So what happens is in the overall indebtedness of the company, when you look at it for sanctioning additional limits, these guarantees come in the way. So guarantees also actually block the fund-based working capital which is available to many of these companies. So it is extremely important that we, boost up this bond practice, bond industry. And very often what happens is that now when a new product is introduced, it is always introduced in a, India is basically regulators are a little conservative, naturally so. So possibly they will have this 500 crore limit for some time, and it will benefit initially the small and middle kind of players, because Indian also the contracts are getting larger and larger. So for many of these guaranteed limits, I would say this 500 crore limit will not be sufficient. So let us at least make a beginning with these small limits and see how it goes. So I think that must be the thinking of the regulators. Now, the problem is that none of the insurance companies, I think, has any project appraisal background. Those reside with the large banks and institutions. Now, how to combine the underwriting actuarial practice with the project appraisal skills will be a challenge. I think insurance companies will need to build that. I don't think working with the banks will be of really desirable in the long run, because each institution takes its time, takes its own views, and the insurance companies, the project bond, the surety bonds actually slightly different from normal common guarantee. So I think they need to have a slightly different approach to this. So 100%, I think they will have to develop their own skill set for this. To develop this market, like one suggestion was made, is it possible to bring, we need to examine, because we can't really afford to wait that long, the insurance industry to mature, because our requirement for infrastructure is right now. We need to do it very fast in the next 10 years. So is it possible to bring in monoline insurance? This is just a thought I had, where monoline bond issuers to here in partnership with Indian companies, so that the expertise can come in fast, the capital can also come in fast. Because India is essentially a capital deficient country. So is it possible to attract these insurers or monoline insurers into India? This is one thought process. I think initially at least MSMEs and small scale industries will benefit from this. So we need to, now that it's not a question of whether it is necessary or not, we need to examine now how to make it practical and popular as early as possible. Thank you.
Thank you so much, sir, for your address. Sincerely appreciate your time on this. We welcome Shri Manoj Kumar, Member Projects, National Highway Authority of India, We appreciate the valuable time which you're putting in to give this address. We request you to give your address, sir. Special address.
Good afternoon to fellow panelists, and I would like to thank ASSOCHAM for having me here. And we have had interesting presentations and on these surety bonds. From perspective of the from the government side, see, we have been working with IRDA for last 2 years on these guidelines, and finally we are happy guidelines are there. The need, as other speakers have already brought out, why we need them, and from NHI's perspective, we need them pretty quickly. As far as NHI is seen as a nation builder today, wherein we are leading infra builder in the country, and this year we are going to award contracts worth nearly 2.5 lakh crore, which are going to up to 3 or 3.5 lakh crore next year onwards. The national infrastructure pipeline is of 100 lakh crore. Out of that, 26% share is of highways. So one can imagine kind of work volumes which are going to come up over next 5 years. And there are approved programs, approved projects, and there is a sufficient pipeline of the projects which is there. At authority and at the government level, we have been working to expand the construction market, because as a country, we had certain level of construction capability, and we have been expanding that construction capability in a very strategic manner, by having contracts of various sizes, so that the smaller players over a period of time graduate to larger projects. There are sufficient reserves available with them, so that they switch over from EPC to HAM project. Just to give an example, 3 years back, we had 6 or 7 players who were doing PPP, HAM or HAM projects. And today, in the current financial year, we have nearly 25 players. In current year, we are awarding nearly 50% contracts to new players, and which is quite an achievement, and which is resulting in competitive bids and faster construction, because we have more hands to build highways. But that poses another challenge, because being newer player for them, there is a huge challenge for them to get bank guarantees, and therein the role of surety bonds come in. Another aspect is we used to have construction contract wherein the DLP, defect liability period, used to be only 2 years. Now we have most of even EPC contracts where defect liability period is up to 10 years. Delhi Mumbai is one example wherein defect liability period is of 10 years, which is huge. So which calls even for the established player, there is a lot of pressure to have those kind of bank guarantees, and being able to have those in place for 10 years. So there's a huge market available for surety bonds in the country, and now onus is on the insurance fraternity to come out with the products quickly. We have already initiated at authority level discussion with the insurance agencies, insurance companies. We have invited them for discussion, and it's important for the industry to come out with the right kind of products. Performance bank, I would suggest performance bank guarantee is one area where the requirement in terms of percentage of contracts is huge. And that's one area wherein these companies can quickly come out with a product, and authority is looking forward to those products, and we are even ready to accept those products April onwards. So from our side, we are fully ready. Our doors are open. We have had one conference with insurance companies. Maybe after 2 weeks, we are going to again talk to them. But it will be critical to have right kind of the products, because even in the present scenario, the contracts, in the existing contracts, there are certain kind of insurance products which are required to be taken. But unfortunately, most of the insurance products are non-compliant to contracts. And as a developing, as we have been focusing more on, trying to expedite construction I must admit, we have been overlooking those deficiency in insurance products. But wherein surety bonds come in, we won't be able to overlook those because here implications are of a different kind. So my advice and suggestion to the industry, come out with the right kind of products, have consultation. It will be important, and there's a huge market for you to work on this. Another important aspect would be pricing of these products. Indian construction industry is most competitive in the world. All established construction players in the world have tried their hands in India, have not succeeded. Why? The reason is our local industry has its own innovative methods in cutting down the cost. The outside construction company, the best in the world, they have not been successful here. So that gives a cue to must give a cue to the insurance players. The pricing this is a highly price sensitive market, because the bidding is so competitive. The whole industry is working on a margin of 5 to 10%. So gone are the days when there were huge margin in the construction industry. It's a volume game. So it will be very important for the insurance industry to come out with right kind of pricing. Another important aspect would be the speed at which you can deliver the products. We at NHI, have very limited time, do give very limited time to the, once a contract is awarded, for signing a contract and then submission of these guarantees. So it's very important. There are standard contracts, and insurance companies do their due diligence about various players in advance. Because normally, typically 30 to 45 days time is available wherein these things would have to be done. And, the first mover will always have an advantage. And there is a lot of scope for disruption in the market. And given the way in the fintech, there have been large number of companies who have come out with innovative products and have disrupted the market. So we at Authority are hoping there will be newer players in the market in next 6 months. And definitely the established players will have to watch out for that. And even the construction sector, the established companies are really having tough time these days. The newer players are doing much better in terms of execution, in terms of quality, and in terms of delivering products. We had also remarked from, in the discussion regarding, the quality of the contracts and the way things have happening. I must assure the audience, as far as, the contracts with Authority are concerned, there have been legacy issues for the PPP contracts prior to 2013. In last 7 to 8 years, the industry can always do and research how many cases performance BGs have been encashed. These would be in single digit, given the size of construction industry we have. So while, looking at the risk, because the pricing will dependent on the risk. So I would request industry to do careful analysis of risk involved in this. And the way this has been managed by Authority, there'll be very few instances and restricted to few groups because of certain regions which are not primarily connected with Authority, the other regions, someone getting into NCLT and those kinds of issues. So my suggestions and requests in this, speed is of great importance. How quickly the products are made available, the right kind of products are to be available, and the industry will have to do the due diligence on the construction players in the sector, so that you are able to you are able to provide them the product, and the infrastructure as a whole benefits with a larger pool of capital available for construction activities. And Authority is always, our doors are open for any suggestions or any discussion on this matter. And we are eagerly looking forward to this, and we are ready to accept these products from April onwards. So that's it from my side. If there are, other suggestions or discussion, we are open for that. Thank you. Thank you very much.
you so much, sir. I think this does bring in a lot of confidence in terms of, hearing from you that how you are open to look at it as, one of the instrument from April onwards. You can see there are huge participation, and I think there are many, many questions. We may not be able to address a lot of questions, but it just tells me that how important this topic is going to be. I have one question from you from, Mr. Sanjeet Rastogi, that there are quite a few obvious benefits for this. However, the reinsurance market is apprehensive about recovery and law, and how NHAI and other state will accept surety bonds since the rights are slightly diluted. So though, of course, you've already shown your openness, if you can, say that what are the main characteristics you would look at to ensure that you start accepting this as a instrument?
See, first of all, this product has, these guidelines have come purely on the initiative of Ministry of Road Transport on this issue. We have worked closely with IRDA because this is a sector where we are feeling there's a lot of scope for, releasing the capital which is locked into with the banks as a margin money. So that's the issue. That's the background of this. As far as authority is concerned, we are ready to look at the products which insurance company can formulate and come to us. And once there are 2-3 products vetted by the authority, then other players can follow the same. Because since today there is no product, it's rather difficult for us to say what exactly would be the parameters of the product. But obviously, it's a replacement of a bank guarantee. So the product has to offer similar facilities to the authority, but within the the constraints a surety bond will have. We are ready to look at those, and we are very open on this. So the ball is in the with the insurance companies. They can have come to authority. We are ready for discussion on this, and I can assure within 15 days we'll vet a product once that product is made available.
Okay, that brings a lot of confidence, sir. We have one question from Mr. Deepak Agarwal. I will request if Mr. Vikash can look into this, that how surety bond function and benefits in lack of capital amongst MSME and micro enterprise as surety bonds. Will ask again for capital investment too. If you can throw any light on that, Vikashi. Yeah, you could probably address this, sir.
I think Vikas is on mute. I was just telling him.
Vikas is on mute. He's addressing it.
Am I audible now?
Yes.
Yeah, thank you. So if you really look at the construct of the surety bond and see that the main features, right? So you don't need collaterals, you don't need margin money, unlike the bank guarantees. And like I mentioned before, bank guarantees actually bred inefficiencies. Now, these are typically tailored towards the smaller businesses. A large contractor in India, I mean, he's already enjoying very favorable terms from the banks that they've got, right? The consortium of banks. So if you go to a large contractor, he'd probably be enjoying bank guarantee rates to the extent of anything between 0.4 to 0.75%. Now, probably, I'm not too sure how what the insurance companies are going to charge, but my guess is it's not going to be as low as that. So a surety would probably cost you a little bit more than that, but would be cheaper than what the MSME is paying currently. So and I'd like to just mention, I was meeting a lot of these contractors in government in the state of Meghalaya. And in Meghalaya, most of these contractors are actually having to put up collaterals worth around 100% of the bank guarantee limits, and margin money to the extent of 13%. And these are cumulative. I mean, it's not either the margin money or the collateral. You've got to put up both the collateral as well as the margin money. Now, that's sort of significant liquidity from the contractor. Hence, he's unable to execute the project, which is reflected in the kind of project overruns and time overruns that we are experiencing in our country. Right? So that's one part of it. So it's going to be most beneficial to the micro and the small and the medium enterprises, MSME segment that you've got. The other thing that was mentioned earlier during this meeting was the concept of SBA, which is Small Business Administration, which is being run in the United States. Right? Now, surety by virtue of their underwriting, they're not just focused onto the financials of financial underwriting. They also would look at capability and the past execution track record, and they would get into more detailed or more holistic assessment, things like even the kind of equipment that that the contractor has. Now, if you've got a capable contractor on board, and if we can have a similar facility like what we've got as the Small Business Administration, I think it's going to help a lot of the small contracting segments as small contractors to actually be able to take advantage of the increased project opportunities that's now we're seeing that's going to come our way, right? So I think the advent of sureties as a concept is going to benefit the MSME segment more than anyone else.
Okay. Thank you so much. I have one question for Richard Wolff by Chetan Thakkar, that how do global underwriters view Indian risk from surety point of view? How are indemnity agreements being legally traded under the Indian laws? And is surety in India applicable only for EPC product, or they are wide? That I can take it later, but internationally, how one would look at it? It will be great to get your view, Richard.
Give you a pretty condensed view of the conversations I've had over the past 4 to 6 weeks. International underwriters, both primaries and reinsurers, are excited about the possibilities in the Indian market, and that relates to sheer size of the necessity of infrastructure. But there are a couple of really big buts. The first one is price. And this comes especially from the reinsurance market, who has made all kinds of experiences with pricing like tariff minus 97%, and this will not be accepted. The thing is, what reinsurers are most concerned about at this moment is the legal system and the way the legal system works in India. So it's not only the law and how indemnity agreements are treated under the law, but also the working of the courts. The time it is needed to get redress for issues under the contract. This is a real worry, and this is something which will need to be addressed. What underwriters are very cognizant of is something which was mentioned a couple of times here. The largest companies will get extremely low rates, but the largest companies are probably the last ones who need surety bonds. The people who need surety bonds are the middle market and the smaller side of the middle market. They present viable risk. And here, and let me stress this, surety bonds are additional to their bank lines. Now, as in any market, financing for medium-sized contractors is finite. So if they can get more financing, and that is quite apart from the margin money and from the collateral they have to put up, so just more financing, it would give a tremendous push to the construction effort in the market. So in brief, what international underwriters are looking for is fast legal redress in case that's necessary and reasonable pricing. Does that answer your question, Nipa?
Yeah. Thanks a lot. This was good. Rajesh ji, do we have time to take a couple of more questions? There are lots of questions, or should we address them specifically?
You can take one question to anyone. Then we request Mr. Vasudev Mukherjee to put up thanks.
Sure. So I have two small questions. So I'm going to take one question to Shri Santosh Nairji, where the idea is just to understand whether the insurance company are in position from a capital adequacy and from know-how perspective to put this bonds in place by next financial year.
Actually, I'm in life insurance, but I would say that generally, general insurance companies are also not really big enough. See, insurance in India remains an underpenetrated business.
Absolutely.
Other than LIC in the life insurance, all other companies are relatively very small. And infrastructure requirements have grown both in terms of scale and the size, and the projects announced now are also very big. Also, as the economy progresses, the scale has to be very big for these people to make some margins. You can't do small projects. So
Yes.
it'll be very difficult for them to do to bring in adequate capital. They will probably need to, scale it up gradually. One of the solution which I was thinking was whether we can bring specialist monoline insurance with this huge capital, because right now 74% the capital is allowed. Overseas capital is allowed. So whether should we go for that route? Who does only this kind of business? So general insurance has got so many other businesses. The capital requirements will be large. One more point I want to add is that in India, because of the weakness of the banking system in terms of inadequate capital, again, even the large, infrastructure players are sometimes very breaching the exposure limits. So they also will actually opt for surety bonds if it's available.
Okay.
It's not that they don't require it completely. It's probably arises from the inherent weakness of the banking system in terms of capital.
Okay. Thank you so much, sir. And I have a last question from Mr. Narayanan, that which sector do you think will, of course, it's very clear that it's going to be for infrastructure, but over the next 1 to 2 years, which are the other sectors apart from roads which can use, and what's your broader view on that?
Thanks, Nipa. I think, look, in the context of the product and the profiling and some of the comments which the panelists made earlier, I think this will start off with roads, infra to, when we see the initial offtake happening in this product. And eventually this could find its way through to any PWD contract as well, right? That calls for, infrastructure development across the country. So it could be railways, it could be, for instance, something that has to happen in the context of roads, or it could be in the context of, real estate sector as well. So I think the potential is immense. And I think the key point is to make the right start. And that's where I think, Mr. S.B. Nair made some very relevant points, and Mr. Manoj also made some very pertinent points, I thought, about how time is of essence here. And so it could essentially, be anything in the infra space, whether it is roads, ports, or for that matter, eventually, scaling down to, any real estate development that happens in any SEZ space. GIFT is another important sort of initiative the government has introduced, and government is looking to scale up the GIFT business as well. So that could potentially be another reason where you need a lot of medium and small players coming through. As Mr. Richard Wolff also rightly pointed out, the big ones aren't the ones who we need to target. It's the medium and the small guys. So anywhere you have infra development happening in the country, there is going to be a direct correlation to this product and a logical fitment there. That's how I see it.
Thank you so much. I think we can take up a lot of questions on one-on-one answers on here. I will now request Shri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM, to give a vote of thanks and concluding remarks.
Thank you. It's now my pleasant privilege and pleasure to propose the vote of thanks. On behalf of ASSOCHAM, I would like to sincerely thank Mr. Manoj Kumar, Member Projects, National Highways Authority of India, Mr. Santosh Nair, Chairman and Independent Director, Reliance Nippon Life Insurance Company, and Mr. Richard Wolff, Executive Director, International Credit Insurance and Surety Association, for accepting our invitation and sparing their valuable time to address the industry. Also, I would like to convey my special thanks to our esteemed panelist, Mr. Vikas Khandelwal, for his valuable inputs, and Mr. Venkateswaran Narayanan for preparing such a detailed and insightful presentation. In addition to this, I would like to thank all other esteemed panel members, delegates, and our sponsors for their support at this timely and meaningful discussion. ASSOCHAM applauds the government's decision to allow surety bonds substitute for bank guarantees in the government's procurement. The insurance regulator, IRDAI, has come out with a framework for development of surety insurance business in the country, which will come into effect from April 1st, 2022. That allows Indian general insurers to commence surety insurance business. This is a big boost for project financing with overall improvement in project viability. Finally, I would like to highlight that in the budget speech as well, the Honorable Finance Minister, Ms. Srimati Nirmala Sitharaman, mentioned that the use of surety bonds as a substitute for bank guarantees will be made acceptable in government procurements to reduce indirect costs for suppliers and work contractors. Businesses such as gold imports may also find this useful. With these words, I'd like to conclude my address and urge everyone to stay safe. Thank you all very much.
Thank you so much, Deepa ma'am. Thank you so much for all.
Thank you.
Now we will start with the first session.
Thank you, Mr. Rajesh.
Thank you.
Now, Venkat sir, you can start the next session.
Thank you very much. So, a very great, insightful 1 hour in terms of all the key issues, themes, the merits about the surety bond product that we all spoke about. And with that context, what I thought we could try and do is have this panel conversation about some key matters around how do we ensure successful launch and implementation of this product, given the much needed infra funding, within the country. So maybe I'll start off with a common question for all the panelists, in the sense that given all the talk about the infra spends, the sector where we will likely see interest, is there any view on which particular product type on the surety bond side is likely to see the maximum offtake? Because the IRDA circular talks about 5, 6 different types of those products. So a question in this context was, which one do we likely see witnessing maximum sort of offtake to begin with in this space? So maybe I'll request Mr. Akshay to share some opening thoughts, and we could then toss it around the panel.
Yeah. Thank you, Venkatesh. I hope I'm audible properly. Yeah,
Yes, I can hear you.
this is a volcano of opportunity for India. And I think Mr. Manoj also spoke a lot about how things are going to be next 3 years. The short-term offtake is obviously going to come from the contract sureties. That's a huge market. we are already getting pipelines from contractors with respect to their future projects and what type of support they are looking at. So in at least for next 2 or 3 years, because there is a cap on the maximum premium which the insurers can do in terms of 500 crores or 10% of the GWP, that would be something which would be the first or low hanging fruit, because most of these non-life insurers, they understand projects, what they have to get in, and I think you covered it in your session as well, is project finance experts. So if they are able to bring that in, I think that synergy will ensure that this is the first to pick up. And I'm sure this is a huge market. So slowly and steadily we will have others coming in, code bonds, custom bonds, and I am very hopeful that IRDA would be looking at it very positively if the expands increase. So that's all from my side.
Very, very useful. Thanks, Mr. Akshay. A related question in this context, maybe would request Mr. Pankaj, if he's on the call, to share some thoughts on, how he sees the overall preparedness of the general insurance companies in order to, introduce this, launch this, because IRDA has a standard documented process around file and use before anything can sort of, be sold in the market. And therefore, how do you see this unfolding in due course of time?
So, as all the other speakers, including you, have mentioned earlier, that there is an expertise which is required basically for absolutely into India and surety, because if you understand globally, is done on the basis of basically less collateral on it should be of expertise. So I think there should be one thing which we all mentioned about, something on the court side. What should be made available to all the clarity should be given to all the insurers about the recourse available. Probably in the IBC and the Surface Act, more clarity on how performing. Probably also getting into the consortium type banking and sharing of information with the banks in terms of the flows of funds and everything. The clarity should be provided on that part. And the second part is that yes, there needs to be what you also mentioned about arbitring as a important aspect for the surety to succeed and for the government to reap out the benefit out of this. I think there is a huge amount of investment which is needed on the technological side. Which I think if online surety companies or standalone companies are about to come into India, will invest into, because that would be their main product and area of prime focus. So that's where I think it should be done.
Thank you so much, Mr. Pankaj. Thanks for your thoughts on that. A follow-on question, building on these two, Mr. Pavanjit, if I could have your views, is there was during the course of the earlier session reference to how central government contracts and state government contracts are seen differently. And from a holistic sort of point of view, given that infra and associated plays are a nationwide sort of a theme, how do you see market penetration happening, in this context, in terms of parties showing willingness and ability to understand what surety bond as a product means for each stakeholder?
So I'd as an insurance advisor, I think I'd like to put this a little bit into context. We had a few years ago a lot of excitement around title insurance, where in the RERA Act, title insurance was made mandatory, and a lot of work was done by insurers and reinsurers to bring the product to India. But I think many years on, I think just hardly a handful of policies have actually ever been sold. And those provisions of RERA really have not been implemented. And then you have to ask yourself really the question that who is your customer? Is it the contractor or is it the principal? And I think given the nature of this industry, I think, in a sense, it is the willingness of the principal. So the market really has to be made between the principal and the supplier of risk capital, which is the insurance companies. My personal assessment is that the IRDA notification caught the insurance industry a little bit by surprise. They don't seem to have done much homework as of now, and I think people are many are waiting and watching. So I think it's important that the larger insurers really put their hand forward in this very important act, I think, of nation building, and we should do whatever we can to support this initiative. But as the as the learned gentleman from NHI said, I think they are willing, and I think we should embrace this opportunity, engage with the principal, and find ways to make this happen at the very earliest.
Thanks so much, Mr. Pawanjeet. A follow-on question for you again, given the interesting observations you shared. Do you reckon for the initial few years for this product to be launched and sort of stabilized, the general insurance companies would want some kind of a sovereign guarantee or a government guarantee, either from state or center, depending on who is awarding the underlying project, to be issued onto them? Do you think that is some kind of an expectation the market players will likely put forth as part of their submission?
I mean,
And how do you see that unfolding?
Who would not like a sovereign guarantee? But I think we will all have to do our homework. I personally don't see a sovereign guarantee coming about. But as I think while there is a lot of confusion and a lot of trepidation around enforcement of contracts, I think very clearly, as was expressed by NHI earlier, that if you look at the rate of enforcement of bank guarantees, it is actually negligible. And that is, data clearly shows that. And I think if and since the largest buyer of projects is NHI, they are, in a sense, their interest is not in financial encashment. It is in completion of projects and putting the road to use for the nation. So I think the industry will have to do its homework and take a little bit of leap of faith and work with NHI, to carry the risk and to build its infrastructure in being able to assess. I think assessment of loss is a very important aspect, and I think that will take time. I don't think the industry is ready and has thought through all those aspects yet, but that will happen.
Understand. And staying on that point, actually, many of the GI players now are also listed on the stock market, and there is obviously the investor and the street who are important stakeholders in terms of any such new product being launched and how the market perceives the risk that the company is now taking on. And assuming a situation that absent any kind of a state or a central government guarantee cover that is made available, it'll also be interesting to see perhaps how markets react to such a product issuance and how they price that risk in the valuations of the respective issuers. Of course, it's going to be time bound. Any thoughts in that context, Mr. Pawanjeet?
So I think it'll be both ways. I think the market will also wait and watch that, what if the players do not participate in a very large opening up of a new area of the industry. I think,
Right.
I think if you look at any new initiative, I think if we look at cyber insurance for that matter,
Right.
Do we really understand the risk? How quickly does the risk change year on year basis? So I think risk is work in progress. I mean, as we discuss, cities are being bombed, and here we are discussing surety insurance. So I think, risk is a changing, and this is our business. I think we will find ways to adapt and to find solutions. This is not something that is being done for the first time in the world. And
Right.
while India has its own challenges, I think we do manage to do fire insurance and liability insurance, and I think we'll pretty much figure this out.
Understand. Interesting point you made about cities being attacked and bombed right now as we speak. So yeah, we are discussing surety business in such an evolving and a dynamic market. There was a lot of reference, to this entire data sharing and information symmetry as well, because you look at the lending side of the play where credit information is shared with the regulator. There is a Bank of India, and the banks also have access to information on how the different borrowers are performing in terms of any overdues or any of them becoming non-performing in that sense. How does IRDA, for instance, do you think will approach a data sharing mechanism around the whole surety business, and maybe it'll be useful to have thoughts from Mr. Akshay on this topic on, how IRDA perhaps may want to get to data repository and information sharing, because while initially the thought process is to try and support the whole roads and infra around it, I'm sure for this to survive its course, this will have to also expand in terms of product fitment. So how do you think IRDA should start planning for this rather than having to deal with an unknown commodity later on?
See, if you look at the regulations which have come in and whatever our interaction with the regulator have been, uh, everybody have very high hopes with this new product which comes in. Uh, Data collection is obviously one of the things which will come in probably as the product comes into foray. The beauty is that currently, though it has been allowed players, what I foresee out of 33, 34 players which we have in the market, with the solvency margin condition, we would have not more than 12, 13 people who would qualify. Of which, if we take away specialized, there are hardly 7 or 8 players who will be actually in a position to issue surety. I think that's very important. Uh, in terms of data sharing, I think that has to be there because the beauty of surety globally is that a lot of weightage is on the subjective assessment of the contractor. And while insurance companies are a data mine themselves, where they know how the project has been functioning, what are the challenges, etc., etc., but a subjective assessment and a financial assessment is something which underwriters have not done in current scenario. So this data sharing, probably a platform or by publishing data or insurers having direct access to that particular data, or only insurers having that access to data, will indeed be a game changer. But for that, we have to have a scale. So we have two things, like one is about data and what you make out of the data. So to make out of the data, you have to have some numbers to justify. So maybe 3 years down the line or 2 years down the line, we can foresee this to coming up.
Useful. Thanks, Mr. Akshay. Mr. Pankaj, one question where it would be useful to have your insights is, we spoke about the entire skill set gap, right? Conventionally, how we understand a general insurance company setup on how they go about doing risk assessment, underwriting, eventual pricing. Now, there were references in the earlier session as well to the whole aspect of the need for a project management type skill set and somebody who understands, say, project finance in a much better manner. Do you believe general insurance companies presently, in the way they are and the kind of talent they sort of attract and the profile of people who work, will they be suited to do this kind of risk assessment? Because this is not just a point in time risk assessment. There were references that were made by Mr. Nair to, the defect liability period, and Mr. Manoj also made references to defect liability period, which extend to beyond 5 years, 10 years on a case-to-case basis. So how do you think this whole skill set gap can be bridged? And if at all there is any scope for leveraging skills that are already available in the GI. So your thoughts on that, Mr. Pankaj?
So basically, to answer this, I will take you to the basic assumption of how risks are assessed on a surety side, as different from the insurance side. Basically, the surety underwriting is done on an assumption of zero loss basis, which means that the underwriter approaches the proposal with it may certainly be fulfilled from today's perspective. So it's different from insurance perspective if you see the assessment side. So the risk assessment pricing all has to be done with perception basically. So there has to be a mindset change. Maybe the current GI professionals or the risk professionals, if the thought process is aligned towards the surety thought process globally, can do this. But I think there is a new set of expertise or preparedness needed for this side. So people from project financing background, what earlier speaker has said, from the banking industry or the financial institutions, aligned to the current insurance professionals might be able to help this. But I think there will be a great play or great contribution which would have to be done by probably the experienced surety people across the globe, and that's where it should come. And this is where the difference is. I think the basic of approaching the underwriting for both insurance as well as surety is different. The bases are different and the methodology are different. On the technology, on the monitoring side, what you were mentioning about this, the current set of team, I think might only be able to do data monitoring or financial monitoring kind of thing. What we need out over here is project monitoring, as you rightly said. But given the size and the scale of spending, what we are trying to do in the India infrastructure sector in the next 5 years, 10 years, I think there has to be a huge and huge amount of use of technology which has to be done to monitor these projects and monitor the progress on the projects, take corrective actions if required, because that's where investments will be required. That's where the specialized will be required from the project monitoring side. So that's how this goes.
Thank you very much.
Thank you.
Venkatesh,
Question?
Venkatesh, if I could just
yeah.
two bits.
Sure.
Sorry,
Yeah,
go ahead, Akshay, please.
No, I was just saying, see, I'm generally an eternally positive person. I believe industry responds to the demand. So if there is a business potential, expertise will get developed. There might be certain hiccups on the way, but that will happen. I joined insurance industry about 17, 18 years back. And frankly, at that time, insurers were hiring people from different streams. Some were plain engineers. I was selling cosmetics in L'Oreal. There were other people who joined in, and with time and with experiments, they did develop and refine this. So I believe there might, like, as I think this has been repeated multiple times, project finance is something which is a gap. Subjective assessment of underwriter is a gap. With current data, current talent within the GI sector. But these are not alien things. There are people who are already doing it. We just have to get the right set of people together, put them in a box, make them innovate. I am pretty hopeful that the market is capable of delivering it. So these are just my thoughts. Yeah.
Yes, right.
Sorry, just to add to what Akshay was saying, I think if you look at the insurance industry, I think if I take a simple thing like motor, in the last few years, a lot of insurers have taken motor claim assessment in-house from third-party surveys. If I look at health insurance, a lot of companies have built their own TPAs. If I look at, when cyber insurance started, you would have to interact with, say, KPMG UK for a Tata AIG to really get a cyber policy underwritten, right? So I think the industry has a very well-proven track record of knowing what its limitations are, bringing, outsourcing the risk assessment to the best possible minds, and then, doing the financial underwriting. So I see this as nothing different. If I look at title insurance, I mean, what are you underwriting? You're underwriting the legal, the framework, right? So that's, that's something that was also very well understood, and a lot of companies put a lot of hard work into, developing processes around it. It's unfortunate the market didn't take off, but the skills, I think, are there, and the mindset is there. I think we are an extremely versatile and adaptive industry, and we will certainly rise up to the challenge.
And one positive thing, Pawanji, just to add to what you're saying, is that central government especially, they are ensuring that from 1st April onwards, it's not just NHAI, but almost all central agencies who are going to be contracting, they will give contractors an option to give either a BG or a surety. So the demand, and I think this was one of the ask as March which we had with IRDA, if the demand is there, and just imagine the size of demand we are talking about, supply will happen. An industry where our industry is a very resilient industry. From 20 years, it is growing at double digit. How many industries can do that?
This will mature with time.
Well summarized.
Yeah.
Right. So, useful insights. If I were to go on to the next question I thought about was, insurance is all about risk and pricing the risk right. So, there were a few questions on the chat box as well from many of the participants, and one common theme that did circle around was, is this likely to be any cheaper than a bank guarantee, the surety bond as a product? And therein lie multiple layers on If yes, how? And if no, then what next? And how to sort of try and take things forward. So maybe Pavanjit, if you could share your thoughts on how you see this panning out, the whole price discovery. Because end of the day, it's the same risk that one is talking about, whether you call it covered through bank guarantee or you call it covered through a surety bond. The inherent underlying risk remains the same. So how do you see the pricing panning out?
Sorry, was this addressed to me?
Yeah.
I'm sorry, I lost you. So
no
yeah,
problem.
so see, I think Vikash answered this question earlier very beautifully. I think there are two forces at play here. One is the premium cap. You know, and in insurance, definitely underwriters would want spread of risk. So nobody would want to take on a very large contract earlier on and then run the risk of that one contract failing and impacting the balance sheet. So the market will naturally gravitate towards smaller players and smaller projects to begin with. And in the issue with the smaller players, as Vikash very well pointed out, is access to capital. So the industry will be solving not a rate problem, but the ability to do business problems. So we will be enabling them to do more business and enabling them to do business powerfully. So I think that is the real issue. And I think what will happen is that as the mid-sized contractors, mid to smaller contractors, they go through the process of bonding. Okay, I think a little, the guys who do well, the rigor of being bonded and being bonded well and wanting a better and seeing it as a business enabler will actually start, hopefully over a period of time, start showing you differentiation between good contractors and bad contractors. I think that is a very important aspect also that will come into play. Companies who are bonded and who are supported by strong guarantees will tend to do better as far as business is concerned. So that is how I see it playing out.
Useful. And I'm tempted to ask you a follow-on question there, Mr. Pawan, and with reference to the point you made about differentiating the good versus the bad players in that sense. Obviously, over time, everyone will gravitate towards the better players, the good players in terms of issuing the bonds. But herein lies the dilemma or the dichotomy that many contracts are getting awarded to newer players over time, right? And the idea is to have a broader market and not just concentration amongst 3 players or 5 players. So how do you see the risk assessment happening, while there are actuaries, etc. at play? Do you see risk assessment and the correlated willingness of the insurance companies to take on board such newer customers who are coming into this business? Because eventually that has to happen. We all understand that for this product to be successful and for the funding issues, etc., to be sorted. So how do you see that shaping up?
Personally, I don't see this happening in the initial period of time. I think the industry would also be cautious. The reinsurers would also be cautious. They would like to and again, as I said, the amount of premium that can be underwritten in the market is not huge in any case. I think the message that what the regulator is also giving very clearly is that we want you to take small baby steps and don't take steps in such a way that we are forced to pull back because we fear for your solvency. I think so. I think in any step of market creation, you have to take slow, steady steps. The market will learn. We will learn. We will go through claims. We will go through defaults, and perhaps in the early years, giving surety to the newest players. But it's like in a sense, it is like the private equity market. What the private equity market was 20 years ago, the ability for a new person to get funded 20 years ago and what it is now is a world of difference. So it's pretty much the same principle, right? As the market expands, as you see success, as more capital flows in, you understand how to take risks and how to set off winners versus losers.
Useful. Mr. Pankaj, a question for you.
Yeah.
Is that, a lot of these infra projects, right? There are multiple suppliers and performance of work by one potentially could have a bearing on the ability of the other sort of contractor to fulfill their obligations and their commitments, because unlikely that it's just one contractor or one supplier who does everything start to finish. While there could be one primary principal contractor in charge of everything,
Yeah.
but there are layers underneath. So how do you see the insurers approaching the whole product profiling over here, in terms of who are they? Will they be willing to underwrite a component, or will they want to look at the project in totality and then decide whether they are going to give a surety bond to the principal contractor or to a participant down below who is one of the stakeholders or the suppliers catering to that project?
So I think, as probably you also already said, that this is to be a cautious approach in the beginning. I think these guys, the insurance companies will look at the primary contractors as of now, and basically what they will have to look at is in terms of what they will do exactly, and what has been their track record in the past in terms of the similar contracts, what has been their how has the commitments gone. It's how they will have to the overall product. What you're talking about is maybe give surety for performance, monitoring the performance of all the subcontractors or contractors. I think you meant to include also into this, like subcontractor suppliers or whatever. So I think those are yet to see some light. It will take some time, but it is if you talk about perfect situation, that will be a situation where they are monitoring the overall project, or they are giving surety for the whole project. They are also allowed to monitor the overall all the suppliers, all the subcontractors on the site. That will be a perfect situation, but I think it's going to take time, and people are going to concentrate on primary the contractors who are required by legislation or the bid documents to submit the guarantees. Subcontractor guarantees currently are not prevalent or not that much funded by the main contractor, because both of these are also. So they might not be able to give surety, they financials, or they give things does not allow the bank or the insurance companies to give guarantees. So I think it will start with the primary contract first.
Understand. Useful. Thanks so much for those inputs. A question, I thought in the reference to the comment I made about the status of being accorded financial creditor and recourse under the IBC laws. Mr. Akshay, do you have any thoughts on this being one area of representation that industry may make to the lawmakers, just so that they are at par? Because eventually, invocation means a payout, right? Which is very similar to what happens when a BG gets involved. So do you see representations likely to be made for being considered at par with a financial creditor by the GI companies?
Yeah, Venkatesh, I personally believe this is one. I think this is one of the ask items. So just to give you a perspective, from about 5 years, 6 years since we have been pursuing this topic of surety and met so many contractors, while we have got good success in certain geographies, most of the underwriters do not want to come to India or support Indian contractors or sign an indemnity bond in India, purely because they are slightly scared of Indian legal system. And with all our imperfections and perfections and how we are evolving with every year, uh, underwriters are not, frankly, if you talk about large players like Swiss Re, Munich Re, or other travelers or whoever, they are not worried about a 5, 10 million, 20 million, 50 million loss. But what they are worried about is a 2-decade long legal backlog. I think that is what drains them, and that is one of the reasons. So yes, I personally believe this is one thing which will come up when a monoline insurers come in, or even GI players or reinsurers will ask that if they can be put in the category of financial creditors. It just makes their life simpler. It's not about the loss at their books, which is part and parcel of business. It's about how early it gets resolved. I think that's a very, very key component uh, 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 in terms of how this thing will resolve. And I think it will also impact the pricing part, because when an underwriter looks at pricing his risk, he also looks at as to what will be my cost of risk, my expenses, etc. Now he will have to add legal expenses as well in the pricing. There has to be a factor. You cannot ignore it. And I think that is where probably one of the concern could be for the underwriter. So yes, you will see representations coming in as the product will develop. And as Richard also said this thing in his address, that this is one area which, though people are watching, they're very positive, hopeful, but this is what is restraining them.
Understand. Useful. So it'd be interesting to watch how this space unfolds and how the product eventually picks up. And one, maybe last question from my side is, and this for all the panelists, and it's all interlinked, right? I mean, this reinsurance mechanism, do you see international interest in sort of willing to come in and do reinsurance business on the surety space as well? Because that's going to be a very, very important cog in the wheel. Because no one company would want to sit with all risks on its books and its basic business in insurance as to how it plays out. So important to understand what's your take on international players' interests in coming and doing reinsurance in this segment. Common question for all the panelists.
Yep. If I can maybe, as I said, it's a mixed bag because frankly speaking, though there was a committee formation, there were draft guidelines, but nobody was expecting the product to get just launched in India, and it happened. Yeah. And suddenly everybody's because from the regulator also there is a monitoring which is happening as to what the developments are. So people are talking to insurers, reinsurers, all are active, trying to devise a product, but it's a mixed feeling. There are certain loose ends, or rather a lot of loose ends which are yet to be tied up. One of them is obviously with respect to the indemnity document to ensure that in case of an invocation, will they be able to enforce indemnity and get the subrogation, because subrogation lies the key. Unlike probably US or certain parts in Europe, where surety underwriters are as powerful that in case of a default, they are capable to get a contractor from their pool and finish the project. Yeah. In India, that ecosystem is yet to develop. So obviously there would be a challenge. So as I said, there are certain loose ends which underwriters are also, or reinsurers are also looking at it. Interest is immense because this is one huge market. If you see the growth in different markets, it's not very high. And then obviously people are looking for new avenues, and this is a huge avenue.
Thanks, Mr. Akshay. Mr. Pawanjeet, any thoughts on this aspect?
Yeah, I'm always a firm believer that supply creates its, demand creates supply, supply creates demand. I think we are world's second most populous country. We cannot possibly be living with the kind of infrastructure that we are living with. Indian next 2-3 decades, I think India's per capita income is slated to grow. Infrastructure will grow, market will grow. I think players will come. I think we will, and I'm sure, and India has a wonderful track record of doing things its own way. We'll make our own masala dosa out of the surety bond, and I think we will create a market.
Yeah, interesting. Yeah, useful. Mr. Pankaj, your views on this matter?
So same everybody's one. It's a huge market, it's a huge opportunity. Just some clarifications on what we have all been discussing about. I think they're all waiting to come over and start work, but the certain the system, the courses on documents, I think that will be enough for them to start with. And it's initial stage. I think a couple of months, once the product or some kind of interest, I think these guys will be here. So everybody is interested because it's a huge market, it's a big market, opportunity there.
And a related sort of question to what we already covered, Mr. Pankaj. Do you think there are any aspects in the IRDA guidelines that need any modification? And is there any mechanism to try and get that over to IRDA for their kind consideration? Your thoughts on that?
Again, I have earlier told you about this thing. There are 2-3 things. This was quite commendable that IRDA from setting up a draft guide, the study group, then coming up with draft guideline, and then coming up with the final guideline. It was commendable for the government and IRDA. They came up with this pretty fast, but there are certain things which if are improved. One is about, of course, about the recourse. If the clarities are provided, it will be much beneficial to everybody. Second, again about mono insurance companies, because I personally feel that there will be a great amount of investment needed, because the way sureties will function, they will have to invest into heavily into technology and bring in expertise, which will be developed in house in country also. But yes, their experience will make it fast for us to learn and then grow on that. And third would be again what Vikas also mentioned in his inaugural address about bringing awareness into the departments, within the state governments, within various government agencies, to accept this as a product and not hesitate on this part initially, because that would be the key. NHI anyways has worked on this project, so they will be doing it. But yes, there are other parts of the state government is a big spending, so those also should be included. So these 3-4 things is taken care of initially. I think there's a huge scope and huge growth that will be to this market.
Thank you so much, Mr. Pankaj, Mr. Pawanji.
This is Akshay. If I can just add one point over here.
Yeah, sure.
One area which I feel could be a definite game changer for Indian side would be FI surety syndication, or rather, as we call it, bank surety syndication. It would make a lot of difference, because globally, like if you see global markets, there are like Americas, which is outright surety, then Europe, which is surety and bank guarantees are working together. We see a huge amount of bank surety syndication happening across the world, for the simple reason bank brings in their expertise of project assessment, contract assessment of the contract, everything, and surety provides the capital. Now, this is obviously, it's not IRDA subject, it is more of an RBI subject, where they recognize surety companies for capital relief. But this can actually increase the supply tremendously. Surety companies would be happy to have a bank as their partners, and bank would be happy to have a relatively cheaper capital from a surety company. And they can actually benefit a contractor by requiring less of collateral, because in their books, a good chunk is now secured by a surety. And these bank surety syndication work on an RPA model, where it's a pure risk participation. God forbid if a surety is invoked, surety companies pay with the bank. So there is nothing like a waiting period in other credit specialties product. This could be one area. And I think in IRDA guidelines, there is one area which is opened up. It's a small hole. I don't know how to interpret it. I'm not a lawyer. But they say that they can work with bank and principals. I think now RBI could maybe take up or step up and say that, okay, we recognize this for capital relief, and it could be a game changer. I think this is one very important aspect that can actually boost the supply of surety to the market.
Useful. Thanks, Mr. Akshay. So, with this, I would like to hand the session over to Mr. Subhash Agarwal for his comments and thoughts. Thank you to all the panelists for your valuable insight.
Thank you.
Thank you.
Yeah, good afternoon, everyone. It's a wonderful interactive session moderated by Sri Venkateswaran Narayana, Partner Financial Risk Management, KPMG India. I would like to congratulate. I was listening the entire session. You was very great in questioning and taking the answers from the panelists. I think you have covered all topics like sureties can help the infra and construction industry, impact of final guidelines for surety business in India, efficient use of working capital and manage construction related risks to the infrastructure sector, roles of the IDA and sureties will definitely help in the effective price discovery for the government project. So you have covered almost all the questions. What are the various challenges and opportunities? And I must congratulate you and ASSOCHAM for holding this timely webinar, because it has to be implemented from 1st April 2022. And I would like also appreciate the role of IRDA to finalize the guidelines. And I think it's a very great business in US, and it has to be going to be a great business in India also. All panelists were positive. And I would also like to appreciate Sri Pawanji Singh Dhingra, Joint Managing Director, Prudent Insurance Brokers Private Limited, for sparing his time and contribute for this topic, and had wonderful interaction. And other panelists are Sri Akshay Bhardwaj, Executive Vice President, Mars India Insurance Brokers Private Limited, and Sri Pankaj Bhansali, Chief Business Officer and CEO, Equoro Guarantees. So all are very positive. There are certain challenges. It may be possible that IRDA, after the advisory of the intermediary, can modify their guidelines and systems. So at the end, I think it's a wonderful discussion. All has participated well. All audience who are participating in this seminar must be benefiting out of it. I have listened part of the inaugural session also. It was going great. And in the same way, this first session also justify and done various good interactions. So thanks to all and everyone, all the audience, all the panelists, and ASSOCHAM, and those who are doing this behind the scenes, everyone, and all the sponsors who has sponsored the program. So thank you very much. I conclude here. Thank you very much once again to all.
Thank you so much, sir. Thank you, Venkatesh ji, and along with all the panelists. Thank you so much for your valuable time. Thank you.
Thank you for having us. Thanks for the opportunity. Pleasure interacting.
Yeah, really